Welcome back to the Markets Policy Macrocast. I'm John Fagan, joined by Brendan Walsh, my partner in Markets Policy Partners, and we're joined today by Loren Smith, who's the president of Skyline Policy Risk Group. Loren, you're a repeat visitor on the Macrocast, but I think it's an auspicious opportunity for you to give our listeners and viewers a summary of what Skyline Policy Risk Group is all about, and what services you can deliver and how to access those services.
Hey, John, thanks so much. Skyline Policy Risk Group is a research and consulting firm focused on supply chain policy, including infrastructure, energy, trade, and regulatory policy, mainly in Washington, D.C. We are located at skylinepolicy.com and enjoy hearing from all sorts of folks interested in supply chain policy.
Yeah, and supply chain problems, that has been a growth industry over the past 5 years or so, and certainly keeping you all busy these days. We've just seen a parade of headlines. Some of them over the last few months, some of them very near in time to us here. Some of the images shocking, but all very consequential on a human basis. But we're going to be talking about them from a supply chain perspective and how that feeds into the macro picture. So, perhaps maybe you can start out with your overarching view. When we look at the landscape here, there's a lot of geostrategic uncertainty. Obviously, there are disasters. Port in Baltimore, the Key Bridge disaster, the earthquake in Taiwan. It just seems as though it's one after another, a parade of horribles for the global supply chain. Maybe not as acute as the COVID crisis, but perhaps an accumulation of stressors at a time when central banks around the world can ill afford prices to be going up. So let's start with your overarching view and then dive into each of these elements and talk about them in more depth.
Well, thanks, John. I think the longer term picture remains relatively positive. The structure and resilience of the supply chain generally, in terms of the freight industry and the freight sector, both in the U.S. and internationally. But there are a number of storm clouds that we're keeping an eye on. You've got the persistent inflation, which now seems to be sort of hovering with some degree of resilience itself in the low threes, just above 3%. And then, as you alluded to, we have had a number of specific shocks. I would list, among them, the situation in the Red Sea, which has forced the rerouting of container ships. The disaster at the Francis Scott Key Bridge near the Port of Baltimore, which has shut down transit to and from the Port of Baltimore. You also have the earthquake in Taiwan that shut down the port there, at least temporarily. And the sort of general global tensions, the geostrategic tensions between the U.S. and China. And of course, we have multiple hot wars, shooting wars going on right now as well. I think each of these things, none of these things threatens to really destabilize global trade, but there are challenges that have to be overcome.
And when you look at each one of these in turn, what has been the Red Sea issue obviously has been with shippers for a while here. Are you beginning to see some of the effects, some of those prices come through, or are you seeing, is it becoming more acute as the situation drags on? Is it becoming, ameliorated in certain ways? How's that been playing out?
So the Red Sea situation is definitely ongoing. The efficiency of the freight sector generally has distributed prices or the premium there more or less around the world at this point, not perfectly evenly, but in terms of the rerouting affecting the pricing on container ships having to sail around the Cape of Good Hope. around South Africa, the southern tip of the African continent. And so that has prevented any sort of major choke point with global trade. Again, just with that ding of that extra cost. Obviously, regionally, it's a significant factor, especially if you conduct business at the Suez Canal. That's a challenge. I mean, it looks like the situation there is just going to continue to be dicey for at least the balance of 2024, possibly beyond. I mean, another interesting thing that's seeing is what contributes to maritime security. You have large ships that can be affected by very low cost drone attacks, and that's been a tactic that we're seeing employed there, and how that gets mitigated over time, because again, you can have a very cheap drone, and you're tying up very expensive sailing ships, and so that's a real challenge, in terms of securing that maritime corridor.
When we look at the headlines, obviously there's, we're at it perhaps a pivotal point in the Israel-Gaza war. There's discussion about over the weekend about Iran directly sending missiles into Israel and expanding the war. Then potential ceasefire. It's obviously could, a very fluid situation, very difficult for even, I think, experts probably to assess. But when you look at the consequences for global trade of a wider Middle Eastern conflict, this metastasizing to an outright, Israel-Iran conflict, what are the, it's obviously not going to be good for global supply chains, but what are the areas where this really begins to impact? Is it oil prices primarily? What other sort of shipping and other trade vulnerabilities would there be wrapped up in this kind of conflict, wider conflict?
I would say oil is the leading one. We could look for a sort of a global premium to be ticked onto the cost of oil. I think this is awkward to say, but I think the world is used to sort of like thinking about the Middle East being a place where there's some unrest and some wars going on. I mean, the U.S. was in Iraq for a decade, from 2003 to 2012, and obviously the war in Afghanistan went on another decade after that. So there being violence in the Middle East is not a new thing that global trade has to contend with. So it's not immediately clear what other trading impacts would happen other than the oil. I mean, oil is a very significant one because a lot of that comes out of the region there. Whether or not major oil producers would get pulled into that, but I would say you would see immediately some anxiety about the possibility of that should there be a war involving Iran. Put it that way. And I think to a certain extent, there's already been, Iran is definitely involved, at least around the edges of the ongoing conflict with Israel and Gaza. And to the extent that it becomes a wider war, I mean, I guess the question would be what else could happen? What other regional players could get pulled in? And I think then you'd see some widening economic risks.
Going into one of the other issues that we saw, you mentioned it before, the earthquake in Taiwan. There was a sense that of confusion about the extent of the damage and the extent of disruption of particularly the chip fabricators and the logistics and supply chains around those. Now that more time has passed, how do you think that that's played out? And then stepping back and taking a look at the sort of wider Taiwan issues. There are obviously geostrategic considerations there as well, and want to get your take on sort of the medium to longer term risks around that China-Taiwan Strait issue.
Yeah, I think the damage from the earthquake there is probably not going to be too severe in terms of damaging either the chip trade or the infrastructure, port infrastructure for shipping. Taiwan, obviously, an important export um, market for the U.S. Rather, I should say, import to the U.S. from Taiwan. There does not seem to be any severe lasting damage to Taiwan there. As far as the China angle goes, does China eventually invade Taiwan? Generally, I've been skeptical that China is going to pull the pin on that. I think the experience of Russia in Ukraine has suggested that it's going to be a lot more costly than whatever may have been the original plan. The idea that you could sort of march in and sort of have at it, and especially the terrain with Taiwan having to go overseas, it's a much more challenging crossing than simply sort of driving down the street, as you sort of metaphorically have to do to get from Russia to Ukraine. And so I think that the China has been assessing that, and again, I'm a little skeptical. There are a lot of reasons to be alarmed that it could be coming. Folks talk about 2027 as being a possible timeline for China to invade Taiwan. Um, I to some extent we just don't have enough information out here in the open source world to be able to tell what they're really thinking. But I think that the experience in Ukraine has suggested that it's a very costly endeavor, and how much of U.S. China trade is China prepared to turn off if they invade. I think an actual invasion would essentially sever trading links between the U.S. and China. And I guess another specific metric I'd look for there is, the not just that the economy is struggling, but the economy is nearing collapse. That's where I would get alarmed, because then you have a real incentive among Chinese leaders to do something to turn the page if the economic situation there becomes truly awful, as opposed to merely sort of struggling.
Yeah, it seems as though merely struggling has been the case for a while now in China's economy, but they've been, a little bit firmer on the accelerator pedal in Beijing in recent months. We're beginning to see maybe a little bit of a pickup. Some of that's playing through in copper prices. And, obviously in terms of their property sector, they have to run faster to stand still, given the legacy overhangs of debt and oversupply and so forth. But yeah, there are indications that, perhaps the rest of the economy is stabilizing, if not really taking off here. So hopefully a worst case scenario. I mean, obviously the Chinese leadership is intent on avoiding worst case scenarios in the economic front. So but yeah, the uncertainties around it.
It's funny. It's funny to think of their leadership being, well, Plan A is to get the economy going again, and if that doesn't work, Plan B is to invade Taiwan.
That's a stark choice. We'll talk a little bit more about U.S.-China relations in a bit, but I wanted to just wrap up with a discussion about Baltimore. We all saw the video. It was astonishing and horrifying. It comes, not long after the, largest infrastructure bill in recent memory was passed by Congress. So it maybe doesn't have the same kind of, wake up call, that could produce a change in policy. There's already a recognition of, substandard infrastructure, and particularly bridge infrastructure and that sort of thing. But what do you think? How do you assess the policy response? And do you think that there is going to be something? Is there a way to turn this into a potential positive if the right steps are taken on the policy side?
Sure. Well, it's several different crises wrapped into one. I mean, you have a major piece of roadway infrastructure that's been destroyed. You have the Port of Baltimore itself sealed off essentially, and probably for several more weeks as they gradually clear that channel out. You have the U.S. With a long-term issue of struggling with permitting reform to get infrastructure built. And so all of these are going to be tested right now. As far as port traffic goes, container shipping into and out of the U.S., that adjustment was made almost immediately, with container ships being rerouted to Port of Virginia, Port of Savannah, New York, and New York, New Jersey. And so that was mitigated almost immediately. The cargo that's trapped in Baltimore will be rerouted over land over time. Then the channel needs to be cleared, and then ultimately the bridge rebuilt. And it will be a challenge for the U.S. I mean, I think the two most visible steps that have to be taken are clearing the channels so that the port can resume full operations. So that's step one. And then step two is going to be rebuilding the bridge. Step one will probably take at least a month, hopefully not multiple months. But the U.S. does not have a deep store of the sort of equipment that can clear this channel. And then the rebuilding process will probably take several years, hopefully not many years, but again, that's going to be a test for the U.S. The 2021 infrastructure bill, the IIJA, as you mentioned, it contained a lot of funding, including new programs meant to tackle large infrastructure projects, very much like this bridge. And I think we all saw in horrifying detail what happens to a suspension bridge when you cut out one of its pylons. So the new bridge is going to have to be a little bit more resilient. It's going to have much more substantial what we call dolphins, which are sort of the large footers at the base of the pylons. The Key Bridge did not have these large footers, and you need to have those. Those had not been added since the bridge was built before the last disaster of this type back in 1980. This bridge was built in the 1970s, and you need a large footer would deflect the worst of the impact from a large ship striking it. But that's it's going to take several years. There will be an economic hit to the area around Baltimore, which does rely on that bridge span. That is a link in the beltway around Baltimore, Interstate 695, which circles Baltimore. So you are going to see an economic impact on Baltimore for the next few years. But nationally, largely mitigated as commerce just sort of routes away from that area. I will say one other thing though, and since we were talking about oil prices, John, that bridge is the artery to get hazardous materials through that region, and so you have to do some significant routing there for oil and gas and other hazmats that get driven around on trucks.
Yeah, that's it'll be fascinating to watch how the progress unfolds, and clearly the Baltimore's that's a resilient town, tough town, but yeah, it's unfortunate that they've got this ahead of them, but
well, you mentioned opportunities, John. I mean, this, if the state and the federal agencies that are on task, if they can rally to the project, maybe we can overperform. I mean, there's been a lot of pessimism over the past 2 weeks about the likely performance of U.S. infrastructure policy, project work over the next few years on this bridge. Maybe they can do it a little bit faster than it's currently being shown. Maybe they can do it a lot faster. maybe this can become a testing point to get, to improve the permitting process and get that bridge rebuilt fast. Get it done in 3 years instead of 7 years. Get the channel cleared in the next month rather than 3 months.
Let's hope. I guess going back to one of the themes that we talked about before, the U.S.-China frictions. We've got an election coming up. Former President Trump is talking tough about tariffs. President Biden certainly doesn't seem to be backing off the restrictions on China, particularly high tech and dual use transfers and so forth. How do you look at the uncertainties that are facing us on the global trade side that sort of pivot around this election?
Yeah, I think that we've sort of entered a new era, so it is interesting to think about it from that way. As you said, you've got Trump who wants tariffs, and you've got Biden who kept most of Trump's tariffs on. So there's not, this is a very different era than, call it 1991 to 2015, where we had China granted permanent normalized trade relations, PNTR, back in 1999, in sort of the heyday of globalization and free markets across the world, a lot of idealism about what that can bring. In the middle of the last decade, there was a real turn towards concern about China's aims and ambitions and plans, and so that in a sense, Trump was both the cause and the effect of that shift, and the Biden team came in and said, yeah, actually, that we agree with all that part of the program. And so that you do have to look a little bit more closely to determine what is going to be the differential effects of either a Trump restoration or a second term for President Biden. And I think that the emphasis of the Biden administration on, say, on electric vehicles in particular, means that they're pursuing a lot of trade policy goals with respect to securing the U.S. critical mineral supply chain for EV batteries, and so that's been a priority. For Trump, the focus is much more closely on U.S. manufacturing and sort of a more general putting pressure on China to try to improve the trade balance there. A lot of these, you could quibble a lot of these nuances. The Trump administration will definitely be interested in securing critical minerals, and the Biden administration is definitely big on increasing domestic manufacturing. The big picture here is the U.S. is in the middle of or at least at the front end of reindustrializing in a way that I think will be really interesting to watch over the next 20 years or so. And so I think that there's a lot going there to pay close attention to. And then infrastructure is definitely going to be part of that story. How do we build infrastructure? What's the process for it? Can the U.S. do something to catch up to a little bit of the rest of the developed world, which all of those other countries, whether it's France or the Netherlands or Japan or the UK, all seem to do a little bit better job building infrastructure when they need to than the U.S. does.
That reindustrialization, it's part and parcel, hand in hand with friendshoring, reshoring, taking strategic supply lines and non-strategic supply lines out of China, and places where feel a little bit more confident that you can count on the supply chains continuing to run under whatever geostrategic circumstances might befall us in the coming years. That's and the necessary job of reindustrializing, of reorienting U.S. infrastructure to allow for that reindustrialization. That requires workers. We don't have a whole lot of those workers. You mentioned, the sort of lack of machinery. We've got also a lack of personnel, I believe, in terms of the people that can do these kinds of jobs. It's been, it hasn't been infrastructure week has been a punchline for a long time, and it's not really where the jobs have been. So to some extent, it seems that the U.S. has lost its muscle memory. But even as we're, kind of rebuilding those, it's an expensive process. And, we're seeing some of these issues come forward as when people are awaiting this week's consumer price index for the U.S. and producer price index for the U.S. These are critical inputs to the Fed's decision-making process. And as you alluded to before, Loren, there is a sense that one more month of kind of sticky inflation might, as they say, one time is happenstance, two times is coincidence, three times is enemy action, and you get three former inflation in a row, then all of a sudden you begin to contemplate, this higher inflationary paradigm. And I want to get your sense of, that's certainly been our position at Markets Policy Partners. We've seen sticky inflation being the state of play this year, not taking off again, but, persistent and durable upside price pressures from some of these structural adjustments that are occurring, some of which we'd mentioned, but others going on as well. So want to get your sense on,
especially because the explanation for January and February is just it's seasonality. It's the start of the year, so you raise prices and then you go forth from there. So your insight on that is really, really helpful.
Yeah, you guys hit the nail on the head. So in May of last year, so May of 2023, we had 4% inflation. Then in June, it dropped from 4.0 to 3.0. Great, inflation coming down fast. And if you look at the charts that the Bureau of Labor Statistics puts out, coming down fast. And then an absolute screeching halt. And now we have 9 straight months floating in the low threes. It's 3.2% right now, but it was 3.0 back in June of 23. So the progress that had been made since June of 2022, when we hit 9% inflation, has just stopped over the last 9 months. There just hasn't been any movement. So seasonal this or whatever. We have 9 months of rather striking consistency with the inflation numbers, and it suggests that we are at some sort of plateau where there doesn't seem to be risk of a major inflation spike, but we're also not making progress towards getting back down towards that 2%. And certainly, housing prices have been an issue, energy prices have been an issue, food prices are an issue. It's just, can we continue our economic growth? Can we continue job creation? And maybe this is just a set of economic circumstances that we just haven't really seen before, or I don't have a lot.
Yeah, especially because so much of that drop was we actually had outright good deflation because we had crazy inflation because of COVID. But now goods are kind of back to where they are. They're not spiking higher, but they're flat, which when you do the math, that adds to the overall numbers because you're not subtracting anything, and maybe that's just the new normal,
Yeah, well, and the freight sector does seem to be recovering. One of the things I noted from the jobs report last week is that trucking hiring is up. I guess the same with the jobs report. We also hit the leisure and hospitality services sector actually recovered to the pre-pandemic level just in the last month.
Same with construction.
Yeah, construction. Yeah, so I think those things, but specifically the freight sector, I think that's important because that could remove a choke point on inflation if that sector is working a little bit more smoothly and maybe getting back on profitability a little bit better.
Yeah, that's a good point.
Well, thank you very much for your insights, Loren. Any last issues that you want to bring up before we close? Things that are we haven't touched on that are top of mind?
Well, again, we've talked about some of the storm clouds, or sort of cloud bursts here and there with the earthquake, the Red Sea situation. These are things that obviously, very terrible for folks that are on the ground dealing with these things. I think the big picture does remain, continued, global trade. I think probably the biggest threat to ongoing global trade is the U.S.-China situation. Could that could that become a lot more disruptive over the next few years? And so I think that that's probably really, if you're following one geopolitical story, it's how the U.S. and China are sort of eyeing each other and maybe ratcheting up or ratcheting down tensions. That could really tell you, where the global economic direction is going. And then as far as the U.S., does this sort of interesting set of economic data with the jobs and the inflation and wage growth, does that is that something that just sort of like just trundles along, sort of with 1.5% or whatever of economic growth, that could very well be sustainable.
Well, thank you very much. We really appreciate your time and insights. We're looking forward to having you on in the not too distant future and updating us on these vital and very important aspects of the economy and macro picture. Thank you very much, Loren Smith, the president of the Skyline Policy Risk Group. Thanks very much to all of our listeners and viewers. Please find us at marketspolicy.com, and we look forward to the next episode. Thank you.